Hey, thanks for joining us, and don't forget to hit the subscribe, the like, and the notification button for more. Okay, everybody, it's Kevin Wadsworth and Patrick Karim at NorthStarBadCharts.com. Great to have you with us. And our guest today on the show is Hypersonic 78, and he's going to talk to us about Elliott Wave. Good to see you, Hypersonic. How you doing?
Great. How are you, Kevin? Good to see you. Good to see you face to face, and Patrick, or at least ape to face.
Ape to face. Yeah, we're looking forward to learning some stuff about Elliott Wave. It's something that myself and Pat have looked at in the past, and we're really fascinated to hear what you have to say. I know that you're very proficient with Elliott Wave theory, and so yeah, just take it away and show us some of the basics and how it all works.
Yep. So Elliott Wave, Ralph, I got into Elliott Wave a few years ago. I practiced various technical analysis tools, and when I got into the markets, when I first started investing, I was a fundamental, kind of trader investor, looking at news and price to earning ratios, and is this company something that I want to invest in? And for the longest time, I'd put money to work, and then something would happen, the stock would go down, and like, why did that happen? It doesn't make any sense at all. And trying to make sense of that. And I ended up not making very much money, with that approach. And so I looked at, other type of technical analysis tools. And that's really when I kind of happened upon Elliott Wave, I want to say 5-6 years ago, maybe earlier. I'd heard it before, but that's when I really started learning it in earnest. And, after, I guess, failing with other methods, I said, well, I'm going to give this a try. And one gentleman I saw that had done it really well, his name's Abby Gilbert. Shout out to him. I kind of noticed, and took notice in 2011, he called the top in the metals markets, just by a few dollars on gold, and pretty much nailed it on silver, and was calling for a large bear market. At that time, they were doing quantitative easing was being introduced, and other types of things that you think with metals would fly. And I'm like, there's no way, and then years later, seeing that he was right, it's like, I got to look into this. I've got to learn this myself. And so looking at, some of the books I had mentioned in the Substack I recently published, which we'll go over, in a few minutes, kind of dug into it and learned, the basic structure. So Elliott Wave, just in case the viewers don't know, was created by Ralph Nelson Elliott in the 30s. And so he was studying the markets, and we kind of realized that they're fractal in nature. They're kind of chaotic, and they move around in varying degrees of time. And so using his analysis that he built, that and I'll go over the details in a minute of kind of how waves are structured, that he hypothesized that the markets, in 1940, we had just had the Great Depression, war was raging across the planet, that the markets were actually in for a bull market, 70 plus years, and imagine making that call, after everything the world was going through. People thought he was crazy, right? And here's where we are. The S&P 500 for over 90 years has been going up, and in a relentless move higher. So I'm going to go ahead and share my screen, and I'll show you, kind of basics of Elliott Wave, just so the viewers understand. Let's see. We'll go to the Substack here.
There you go.
Okay, can you guys see it okay?
Yep.
Yeah.
Yep.
All right. So yeah, I go through in my Substack, which I just published last week. This is something that a project I wanted to do, just to kind of encapsulate everything that I'm seeing, in Elliott Wave. I've been using Elliott Wave just privately myself, posting some things on Twitter, but as I do more and more charts, I wanted to kind of put the story together of what I'm seeing, and other analysts too. So Elliott Wave, is 5 waves up. All right, all markets move in 5 waves, okay, in varying degrees of time. You've got your first initiation takeoff wave. That's like your early investors getting involved. You're going to put the money to work in a new market, right? And then you have first sell-off. Those early investors are kind of taking some profits, and those sell-offs always happen in an ABC structure. So, this one could be tied to that larger one, and A is kind of your, oh shoot, the rally's over. Let's, we're taking profits. All right, then some buyers come in at A, and then you see this bounce occurring, and then C is like the capitulation move down, like everyone's going to sell, and that's the end of wave 2. Okay.
So what I noticed there, just to quickly pause for a second, is that it's another way of describing what looks like a head and shoulders top, or a Wyckoff distribution, or in the terminology of Stan Weinstein, that would be stage, you have to help me out here, Pax. Stage 4, is it stage 4, stage 3?
Yeah, stage 4 decline. Yeah,
stage 4 decline. So it's another language, before people get a little bit, I know some people are dismissive and sort of instantly have these views and opinions to, this does work and this doesn't work. If you just keep an open mind, because what's being described here, it really is fascinating. And it's, if you look at the markets through a different lens, this is another language, another way of describing what, is also described in different ways. So for me, this is this is fascinating as well, because it's, it's putting what I think I know already into a different language. So it's brilliant. Yeah. So sorry, carry on. Yeah.
Yep. No, that's great. And I'm not super familiar with some of those other methods. I haven't studied them. So it's kind of great that we can, see it with different lenses, as you said. So yeah. And then wave 3 tends to be, that's like the mainstream, is coming in, the more investors are coming in. It's the investment's getting known across, a wider audience, and they're getting involved. All right. So wave 3s tend to be the longest and strongest waves in markets, although not always, and different asset classes behave differently, depending upon the wave. But that's wave 3. And then we'll get another ABC correction down from 3 to 4, same kind of corrective pattern there. And then, that's from like your really early investors taking more profits. And then you got participants that joined in wave 3. Now they're taking profits. Then you've got wave 4, and that starts off wave 5. When all the selling is done at 4, that's your blow off top. Okay. That's like the peak, everybody's in. Okay. It's the mania stage. And we've seen blow off tops in various asset classes. And that's what we call a wave 5 and an Elliott wave. Okay. Y'all, do you Pat or Kevin, have any more questions on the general structure? Or
well, I'm just noticing one thing is wave 2, and thank goodness you highlighted number 1 and number 2 in red. So number 1 and number 2, that wave 2 essentially is a fractal. It's subdivided into a wave ABC type of play out, right? Each wave 2 and wave 4, actually, they play out a wave ABC in each
correct.
of those.
There's an A and a B and a C on 1 and 2. Exactly. From 3 to 4, it's always 1 to 2. You're going to see that ABC nature.
So if this was a monthly chart that we're looking at that perhaps covers a period of years, would you expect there to be, as you say, fractals of this embedded within the weekly and the daily charts?
Exactly.
Yeah,
you absolutely would. Yeah. And that's, you've kind of, I might say terms later on like impulsive or corrective. An impulsive structure is 5 waves up, or you've got that larger 5-wave up move, and impulsive is kind of like there's certain rules to be said about certain types of waves. Like wave 4 really can't go deeper than 1, although it is allowed. Okay. But it's less reliable when doing trading. But it's still, a bull market going up, right? 5 waves. Corrective structures, 3 waves. Okay. So you could have a 3-wave up, but it's almost corrective. Like it's not the prevailing trend that, is present in that particular asset.
Yeah.
Is the wave A after your 5, the wave A down, is that subdivided also in some type of 3-wave pattern?
It sure can be, yes.
Okay.
And sometimes from B to C, we can actually see a 5-wave move down, from B to C. So you've got to be careful. Elliott Wave kind of helps you figure out like what is the prevailing trend, the larger trend over the larger degree, because that that can certainly help investors of like, when do I buy into a market, right? And then when do I sell?
And
Right?
that's the question everybody really wants the answer to, isn't it? I suppose, because if you buy into a market that is trending up, then it kind of is much more forgiving. If you get your timing wrong, as long as you're in a market that has a larger degree uptrend, then whatever losses you might make through timing errors will be overcome, relatively quickly, as compared to, thinking you're buying at a good time in a what turns out to be a larger degree declining market, even though you catch a bounce and you're all happy for a while, and suddenly you find that you're 50% down because the trend wasn't with you. So that is golden information, isn't it?
We've all heard, the trend is your friend. So yeah, if you're thinking that you're still in an uptrending market, but now you're suddenly buying that B wave, you can get slaughtered. So, and psychology really plays, into it quite a bit, right? I mean, viewers who want to like read this Substack, which, it's totally free, go check it out. It's just a collection of, my thoughts and analysis. Again, I should put the disclaimer, I'm not a financial professional. I'm an amateur Elliottian. I've been doing this several years, and this is just my work, that I want to share with people, because I'm pretty convicted of what from what I've seen, that we're in for a tough period of time. So, let me go ahead and do the next chart. And if there's any other questions on basic Elliott Wave, the readers and viewers can definitely, I recommend going to this website here, elliottwave.com. There's a free, you can get a free copy of the Elliott Wave Principle. It's a book. You can download it for free and start digging into all the different structures if you want to learn more. But there's plenty of sources on the internet to learn the basic structures. So that's kind of, step one. So anyway, here is a scary chart. I happened upon this years ago. This was created by Mr. Garrett Patton. He's a Elliott Wave analyst over at elliottwavetrader.com. It's a service that I had subscribed to the last few years. Very good one. There's some really good analysts on there, and I had seen this before too, published on articles that Avi Gilbert had posted on Seeking Alpha. And at first I didn't believe it. I didn't know much about Elliott Wave. I was still learning. I was kind of impressed by his calls in metals, right? Being one of the very few analysts calling for the prolonged bear market in metals from 2011. And then I saw this chart. See if we can make it a little bit bigger. Here we see the 5-wave structure. We're being way back in the 1860s, the initiation takeoff, just before the Civil War. And the major cycle one was the peak at the 1929 top. And you can see here's that 5-wave, that 5th wave, that mania wave, the roaring 20s. Then it corrected back into the Great Depression. Now that decline was just really hard and fast down, right? And this is at the time when Ralph Nelson Elliott was doing his work and putting his theory together. Okay. We saw that move up. And if you really kind of zoomed in, you could see a 1, 2, 3, 4, 5 pattern, up to this one. Then this is called, if this is a major cycle or super cycle, this would be a cycle 1. Okay. And then A, B, C down. Okay. And that's when he made that prediction, that bull market prediction for equities at this point in time during World War II. And then look what happened. It just totally moved up. We get the longest and strongest wave 3 up into the Vietnam War, a corrective, ABC pattern through, the early 1970s. And then, the heart of major cycle 3 leading up to the tech bubble. And of course, that's a 5-wave, right? We saw in the late 90s. And then kind of interesting, the bull markets in the early thousands, the leading up to the housing bubble, that was all part of a larger ABC structure, leading down to cycle 5, which is the bottom of the Great Recession. Okay, so now where we are currently, I believe too, and I believe this chart is valid just on my analysis, that we are now in the last, cycle wave 5 high of super cycle wave 3. Okay, so this chart was it's a couple years old, right? So past the COVID, but we're on our way. And I have my own chart. Maybe I'll skip over to it so you can kind of see zoomed in. So here we have the great financial crisis. and we are in a 5-wave pattern up. And now we are just about attempting, to break free and make the last intermediate wave 5. You can kind of see wave 5 in parentheses there in white of primary degree 5, of cycle degree 5, of super cycle wave 3. Okay, so what we have coming after is a very large degree correction. It's going to be an ABC pattern down, some sort of corrective pattern. One thing to note about Elliott wave is wave 4s tend to drop down to where the previous degree, ended up being around here. So like in this case, it's around 600. I don't know if we'll get there. We'll have to watch. All right, that's where some other types of technical analysis may help. Looking at where some fib levels are. Like on the log scale, I did 786 here. That's around 1295. Another thing to note too is it may stop right here. This whole move up could potentially be just a big one, a big giant primary one. So we have to be careful of that too. But regardless, we're in for a larger correction, lasting at least 10 years, maybe longer. So again, Elliott wave does not predict timing. Okay, I could move this, around anywhere. That's where other tools could come in. But timing models are, in my experience, they're kind of no better than a coin toss. So no one can predict the future, but we at least want to watch the structure. And this tells you where to sell and maybe step aside for a while and assess, really what's going on with the markets first before, going all in or staying in the market, for too long.
Interesting. I'm just comparing in my mind how that tallies with our own analysis, which it's interesting that the stock markets versus inflation have already broken down. So where you've got a support line there and the S&P is resting on it versus inflation, S&P, NASDAQ have broken to the downside. So nominally, I mean, this is just my view, and probably Pat's as well. Nominally, yeah, seeing the S&P going up to whatever that is, 5,500 or somewhere around there, but not making a new high, inflation adjusted, is the way it appears. So it looks to me, I mean, I'm just sort of calling it a great rotation, because for the 4th time since the First World War, there's this rotation taking place of sort of money from where the majority of it is in stock markets, elsewhere. I'll just say elsewhere for now, but sort of hard assets, I suppose, is one way of phrasing where all of this sort of investment capital is likely to wind up. But I'm kind of seeing this as well, and I'm seeing this sort of breakdown taking place, but not nominally. I just wonder, so what if you had to put a sort of probability on S&P making new nominal highs, how, like, I mean, clearly on this chart here you've got it marked at new nominal highs, and that I guess that's what you that's what you require, isn't it?
Yeah, that's my primary case here. Now, if this breaks down further, then we have to reconsider, because then, zooming in, you can kind of see we're going to end up getting overlap between where I have my 4 and this one. So it turns a little bit, kind of a different style. It's less reliable when you have overlap. I'd mentioned that before. It's not really as an impulsive of move. So you can kind of see it's already trying to make that 1-2. It might be kind of, say, climbing that wall of worry, but again, we got to kind of be careful. Is this really going to happen?
So if I mean, that way where you've got the support line there, I mean, if it sort of breaks below that, then it would be a different scenario. And what would you think that the odds of the large decline, being in progress, those odds increase?
Yeah, the alternate count actually for this is that it's not going to follow an intermediate. It's going to do a larger degree type correction, where the whole move here was a 1, 2, and then higher into the late decades.
Yeah,
that's the alternate, but it's kind of lower probability at this time. So based off, what it's already kind of made a bottom here, and it's climbing a wall early. We got some good divergence here. I'm looking at other indicators, and also I kind of see that. That's why I really wanted to dig into, some other sectors and some individual stocks to see if I'm seeing really the same thing. Am I seeing, a little bit higher and this and that, just to kind of add that evidence that yes, this larger structure on the S&P 500 is really valid. Okay.
Interesting. I'm just interested to know if there's any Elliott Wave counts there that allow for the S&P to decline from here down to, well, just to continue declining for the next, I don't know, say 5 or 6 years.
Well, we could get, going back to that, I think, if this were a 1, 2, and it's a deep, deep 2, you could see that. Yes, I would buy that. This would be a, I'd have to change the degree, right? I think actually I have an alternate count here. Let me see if I could find that.
What's the degree again? Can you refresh me what that word means in?
Yeah, the degree is like the time frame, right? Based on, it's not weeks, it's going to be maybe months, if that makes sense. Yeah, it's just identifying what the time frame is.
While Hypersonic checks out, Kevin, me 2 takeaways. It's Elliott Wave is fractal heaven. So if it's fractal heaven, and it's a technique to sell into strength, because from my gut feeling, when you had that thing labeled sell, that means no questions asked. You're hitting that upper rail, no matter what happens, you're selling there in strength. So Elliott Wave guys, they're guys who could brag eventually saying, I sold to the penny at the top, because their techniques permits that. Am I correct in seeing that?
Yep. Yeah, no,
Right?
that's a good assessment.
Yeah, like they could sell at the ultimate top and they don't even ask. Like, that's it. That's my count.
And I think some where Elliott Wave sometimes comes in for some criticism unfairly, as does all technical analysis, is that the accusation, oh, you've changed your count, a bit like us, people say, oh, you've changed your, you've moved your support line or your resistance line, or you're analyzing it differently now. And well, as evidence comes in and as new price action forms, you can't just stay rooted in the past. You have to continually, even as a scientist, forecasting the future, you have to take in all the incoming information and adjust the probabilities accordingly. When the probabilities shift, then you have to reflect that in your forecast. And that's the whole point of having these clear boundaries. And when price crosses one of these clear boundaries, you then know that the scenario that you were tracking is now not as likely as it previously had been, and that's useful information.
Correct. We have to adjust as we go. We got to let I'm a believer that you've got to let the market tell you where it's going. Looking at price, it does rely on history, but again, I mean, the history, that's Elliott Wave itself, and the market is a collection of people's views on the market and what they're really voting by buying stocks and where they think, the future is.
Yeah. Right.
So, and people also have a tendency to herd, irrational herding behavior.
Yeah.
I'm not sure if you guys have delved into that or not, but some people call it sentiment. If a particular stock is going down, they
want to do with fear and greed, isn't it?
Right. Let me show you a little chart. This is from Robert Precher's book, the Socioeconomic Theory of Finance, which I highly recommend, investors read. It's a big eye opener, but it's basically investors really don't know how to price stocks. They can use price to earnings and a number of things, but we're all speculating, and we all are trying to invest in assets with one purpose, right? To sell at a higher price. I put a video there of Rick Rule that was aired on Palisades radio, a few weeks ago, I think a couple of months ago. And he says it really well about, comparison between, buying cans of tuna at a discount versus stocks at a discount, right? Something that has utility, versus, something that I just want to make money on, so there's a tendency by speculators, to buy when the market's going up, when it's going higher, the excitement's there. Okay. Versus now when it's really down, get me out. I want to sell. The market is telling me I'm wrong. And it's actually really hard for people, to do that. If there's another figure I want to show here, it's a different part of the brain that we use. This is also pointed out in the book. The basal ganglia is that piece of our brains that actually gets turned on, by, and it's unconscious, to, join the herd, so to speak. It's hardwired in our DNA. Like when we are in a situation that we don't know, if there's danger or not, or what the future is, then we have a tendency to follow others because we don't know anything to do any better, right? Versus something that's rational, that we can kind of think through, like this, you go to the store and say you see a $10 can of tuna, right? When really the price should be, a couple bucks. Well, I guess with inflation will end up being there. But,
yeah, 10 bucks is probably closer to the mark.
But there's a limit to what you'll pay for that, right? So that rational thought gets, thrown out the door when assets become, when they become financial assets, because now we're just using that primal instinct to herd. And then that kind of social mood and sentiment leads to the structure in financial markets and the movements in financial markets by that, greed and fear, so to speak. If that helps.
That's brilliant, man. It makes so much sense. We have like Kevin and I were listening to you, and we know we have like other techniques like distance from moving average to spot the greed or the fear, and that brain thing there is that's scientific. Like that's really something that somebody came up with.
Well, human beings are hardwired to react like that, because, long before modern society, human beings had to herd together for safety. So it's an instinct, isn't it?
So Kevin, if I go to the bar and I start looking at all the other girls, it's not my fault. My girlfriend can't get mad at me, right?
I love your analogies, Pat. There's always girls and bars involved.
It's not my fault. I'm wired.
I'm not going to try that with my wife. No. I highlighted a good sentence that Robert Petra has here. I mean, and speculators who place bets in financial markets, they have high levels of stress. It's a high stress condition, right? So staying independent of the crowd, right? Just standing out and no, I'm going to buy when these prices are getting beat up. That's very hard to do. I mean, I think I saw a video. I think it was posted on Twitter a few weeks ago. I thought it was interesting. They did an elevator type. It was like an elevator experiment. So they had it set up to where they had like, 6-7 people staying in a big elevator. Okay. And they're all facing the wrong way, not towards the doors, but the opposite end. And they had it set where, they were in there, they're all in on the joke. But when someone came in, they were all turned the wrong way, and she's turning, towards the door, right? And it goes up several flights of stairs. And then they had it to where another person who was in on the play would come in and they would face the wrong way. And by the time she gets up to like the 20th floor, where she's headed, I mean, she just, you can see on the video too, she's just resisting, trying to stay for the longest time, but eventually she turns completely the wrong way. Subconsciously, she wanted to not do the opposite of the herd. And the same thing happens again and again in financial markets.
Yeah, you don't want to be the odd one out, do you?
Evan, do you remember this guy, Darren Brown? I think he's English there. He's social compliance. You go on YouTube, Darren Brown, and that's how he does. People are social compliant. Like they want to fit in with the herd. Like they don't want to be like let's say you go in a room, everybody's standing and there's a chair and you're there. What the hell? And you'll stand, while you should go sit. Why the hell are you standing up? It's because you see everybody doing one thing.
And this is another sentiment reader. I thought this was interesting in the book, and there's lots of examples of this. So you got to read this book, guys. It's amazing. So hemline heights, social mood leading stock prices. I thought this is a very interesting indicator. When we get to the top, of most markets, you can kind of see a correlation between women's hemlines versus when we're in the bottom of bear markets and everyone's feeling, kind of shut down and, in pain, right? The style changes even in society, right? So I saw this, and then I did my own little check and Googled, mini skirts, and I saw all types of, articles saying, oh, women's mini skirts are back. And I was like, wow, what an insight.
The colors also, my girlfriend told me that there's still there's colors, the fashion, the colors. If it's bright colors, everybody's happy. If it's dark colors, so it's crazy stuff. We have to chart this, Kevin. How are we going to chart this?
You're gonna have to chart some women's hemlines, yeah. Let's see. Going back to let's see.
I love this stuff.
Yeah, let me go back to my Substack here. All right, so I think we talked about that. So yeah, what I wanted to do is kind of capture that and introduce in a way where other people could perhaps understand or at least access some resources to learn Elliott Wave and consider it. Just to kind of not sell it. I don't care. I'm not trying to sell anything. I want to share, what I have understood and what I've learned over the past few years. Here's a link to the Rick Roll video. I think definitely viewers should watch that. And then I think other people have seen this video or this, the Wall Street cheat sheet. I wanted to kind of put the wave counts on it so you could, kind of see where the wave 3, wave 5, what's going on psychologically in the markets, in the investor, for where those different stages of, the ABC capitulation, like what the investor would be feeling at that point in time. So just as another example. Again, Elliott Wave, seeks to determine the highest probability outcomes only. So, and again, nothing on timing.
Yeah, I've said this a few times, with technical analysis, I think you have to be realistic and understand the fact that whatever techniques, you use, and if you use multiple techniques, so much the better, because it gives confirmation. But what it really does is it shifts the odds of success into your favor, because you're able to identify the most likely outcome. But there are times in the markets when there's a lot of uncertainty and a lot of chaos, and so there are times when identifying the most likely outcome is effectively not possible, because the full range of outcomes has roughly equal probabilities. And then you progress a bit further in time and it becomes clear which one of those outcomes is shifting to become the most likely outcome. So it's an unrealistic expectation for anyone to expect technical analysis to nail the answer every time. But what it does do is it gives you an early heads up as to what's the most likely outcome. And if you can do that as an investor, then you're going to be successful.
Yes, I think if you can put Elliott Wave with other tools, I mean, that's like you guys always have said on your, on your talks, the evidence, adding up all the evidence together, I think that kind of helps one make up their mind and where they want to invest, for sure.
Yeah.
So yeah, go ahead.
Because I was looking at those numbers, man, and like I look at that, like let's say the 3, the 4. In hindsight, I could probably put them there, but how the hell do you know if they're there before the price action unfolds, right? What's the cue to know that? Let's say, that was the 4. Like, is it because how do you know it's the 4?
So
a pull
now
flag?
You have to kind of delve into the wave structure. Where's my 5? Where's that mania? Like, and there's some wave extensions basic wave extensions you can assign to that. Like typically wave 3s go to the 1.0 extension between the 786, 764, and as high as the 1.382. Now there's always exceptions to that rule. I've seen, major blow off tops go, really extending up higher than you would think, right, on the 5 wave. But that can kind of give you an indication, and that's where I would use other tools to kind of get a feel for like, well, is it topping? Is the momentum starting to leave the market? Are we seeing, some negative divergence build up? So other tools I think can kind of help you identify, hey, am I at the top of that? But again, it's 5 waves. Do I have 5 waves up yet? And and this is in a prevailing trend is a bull market. That can kind of help you. Just as at the same, on a 4, have I had those 3 waves down yet? Or have I had the full corrective structure and what I think is that level of degree?
Yeah, and I think the key to a lot of this is identifying the breakout where where you've got it labeled 1 on the chart there, and the price breaks out and begins to move up. That identifying that breakout from hope, disbelief, moving towards the optimism stage there. If you can buy into that stage of the market there, then selling at any point during the euphoria stage is going to be really advantageous. You don't have to pick the exact top. You don't have to beat yourself up because you didn't stay in Bitcoin until it was 69,000. If you know, Pat did a chart that identified high risk. I think when Bitcoin was in the high 40s or 50, Pat will probably correct me, but it's somewhere around about the high 40s or $50,000, somewhere around there. And sure, we spiked up to whatever it was, 69,000. But you know, if you'd bought in somewhere down near 9,000 as it was breaking out, 10,000, then you know you've got yourself a really good profit there. So you know, far better than these poor souls who sort of bought in at 60,000 expecting it to go to 100,000 and now find themselves sitting with a 50% drawdown or more, you know. So
right, and then
it's all about just putting the odds in favor.
The Super Bowl, right? I mean, we saw advertising go up. That kind of goes back to that sentiment, right? And the laser eyes, and there's other indications you can see. I mean, I was telling, you know, I think one of my, you know, Twitter friends that, you know, once I think he had some eyes that had silver dollars on them. So it's like when everyone starts putting silver dollars on their, you know, on their Twitter, you know, profile pic, that might be an indication, guys, that we need to start selling silver. God forbid, I like silver right now, but
yeah,
you know,
silver's an interesting one because it's been dumping today, and it's yeah, that's one to keep an eye on, isn't it?
Oh yeah, yeah, and I'll cover, you know, that in some later, you know, parts that I have in this. My plan for this is to kind of give that weighted evidence, right? Go through multiple assets, multiple charts to kind of create the thesis. And really that's where I want to get down to, you know, I titled this the upcoming 21st century stagflationary depression. So
yeah,
I mean,
stagflation, that high inflation and faltering economy situation.
Exactly, because some assets I'm seeing the potential for really getting, you know, hit hard versus others that are trending up in price, that are in larger degree uptrends.
Yeah,
so
uranium. Sorry, did I say uranium?
I'll get there with commodities for sure. I'm going to have a whole segment on energy, and I wanted to kind of break apart the S&P 500 first and kind of go through each sector that way. But once we get to that part, for sure, yeah, I'm long-term bullish on uranium. So yeah, and all energy markets actually. Yeah. So looks like they're trending up, but it's going to be kind of whipsawed along the way, right? Because you've got periods of time where there's deflation. So kind of like the 70s and 30s combined together, and it means is kind of the thesis that I'm building, the evidence I'm getting from all these different charts and sectors. So it's not going to be fun, but I wanted to put this out there just so folks can, you know, take in and start digging in for themselves. And if they see the same things, then that's great. I mean, if this even helps just one person, like consider to maybe pay down a little debt or save a little extra money, I mean, that's not going to hurt them if they take those steps, you know, period, regardless what the economy does, right? So I just wanted to kind of put that out there to, you know, I'm just here to help. You know, I want to, you know, I don't want to keep this to myself because it is going to be life-changing if I'm right. And I think I am right, just because of what I'm seeing in the charts and the conviction I have in them and my analysis. I'm by trade, I'm an aerospace engineer, and you know, I've worked in industry for 20 years. You know, the numbers have to be right. The analysis has to be right. I'm very careful with my work, and you know, I think we're in for some tough times, but I think we can all get through it. And if other people can, you know, make some profits on this, and you know, be prepared, you know, have some extra savings to help others through all this, you know, that's the world's going to be a better place. So I just want to be part of that.
Yeah. Yeah. Well said.
So yeah, the way I'll lay it all out is equities. I'll go through the S&P 500. I have a link here that kind of shows, you know, all the largest weighted components. And so for the first article, I just want to kind of cover the technology and information sector, which is like 9 to 10% of the GDP. So I look at the NASDAQ, it's a similar type 5-wave structure, you know, that we're seeing there. Again, a larger degree decline is going to be coming there. So
interesting how cryptos are performing like tech stocks at the moment. I don't know if they're going to diverge at some point, but Bitcoin and NASDAQ seem to be tied at the hip.
Possibly, yeah. I'll go ahead. You know, I have a part on cryptos too. I'll cover those as well. You know, I'll get there. I think I have. You know, I want to try and form these so if people do sign up and choose to get these articles in their email that will fit in one email. Like Substack limits you for that. And plus I don't want to, have too much information that overwhelms, someone who's reading them. So I figured just splitting up into parts that way will help, but definitely do a part, on cryptos just for those who are interested in them. But then I'll go ahead and dive into Google. I've got the chart there again. You'll see, 5 waves. We have this little 1, 2 here. I might as well bring up the bigger chart so it's easier to see. We finished up the intermediate 3. You have your 5 wave move up here, way back from IPO, up to the 1 wave here. If you dissected this, you would see 5 waves. I didn't go down to that trouble, but well, I didn't initially, but I took it off the chart just to, kind of clean it up and make it more for presentation. You have you can kind of see clearly A, B, C down. Okay, then you've got another 1, 2, longest and strongest wave 3, then a quick little 4, 5 waves up to 5 of 3, really fast, sharp move down for 4. And now we're making our 5 wave structure up here. So, and again, timing is, I could stretch this band anywhere. I mean, it just depends on what the market wants to do. So we got to be careful of that. But when I get into this box right here of these Fibonacci extensions, typically wave 5s go to the 1.618 or the 1.786. They could overextend and go even higher. So we have to be aware of that. We'll be looking at divergence when that happens. And
where are you measuring the start? So for your fib extensions, where's
right
your
here,
zero line?
right for right here, I'm choosing. Excuse me. Yeah, right over here, the 1, 2, off the intermediate. You see that?
So you're taking the. I'm just following along. So the 0 line that centers the fib.
There.
Yeah, so I'm taking it from IPO date down to intermediate 2 for this intermediate 5 for these counts. I'm also taking it from this 1, 2 for the green. So the green count are these fibs, white count these fibs.
I see.
That's the box. So they could both overextend though. I want to see 5 going higher than 3.
Okay. So
I'll be on watch. This box is kind of like my way of saying, all right, I need to start watching this. What's happening in the price action? Is it moving? I don't own Google, right? I just created this chart just to, kind of see, what's going on there and to add that added weight of evidence, to the larger S&P 500 chart and what could potentially happen to the tech sector. Let's see. And then also I went through a couple others too, the Google, Tesla, again, different, labels here for, different degrees of time. Tesla's a younger company than Google, right? So we just have some intermediate waves here, finishing up a primary 3 and then a primary 4. And if I say I don't have that one up, but again, I've got some Fibonacci retracement levels of where potentially 4 could go. But as I had mentioned before, wave 4s tend to go back to where the previous degree, the lesser degree on the previous wave 4 went. That's just kind of in the realm of. So, I mean, it doesn't really have to go all the way down to 164. I mean, I think it could probably hit the 382 or even just the 236, right around this level, maybe we'll have to kind of see what it's doing if we've had a full 3 wave down structure. And if we're starting to see some divergences, build up at that C of 4. Again, timing is notional, so we'll have to watch the market. Then I went through Microsoft, and then I finished up with good old Apple, which is a very large piece of the S&P 500. It also has a 5 degree wave that it needs to structure that it needs to follow and finish up. We have the 1, 2. Now we're going up to 3, and it's a tiny little 4. Sure, we could see this 4 go down a lot further, right? But it's making its way up to that 5 structure. It kind of started off its life in this diagonal, where you have overlap between waves 1 and 4. Kind of tricky to trade in and out of. Then it just, right after this 2, it just took off into this very large impulsive structure, all the way up to now we're finishing up primary 3. Apple will be a good one to get into. Like if I'm right, well, when I'm right, at some point, when it bottoms here, that's a generational buy right here. because then we've got wave 5, coming. Who knows how high that's going to go? It depends upon, this extension, but, you're set up. That's a time to be brave and start buying in, to a market like that if it shows signs of bottoming. So next time that kind of finishes up for what I had for the technology. I'm already working on part 2. I hope to get that out by Friday. But just kind of what I'm already seeing is some scary things in the banks. And that's why I think it's, highly deflationary. I charted Citigroup, and the structure here is not impulsive. It's very bearish. I mean, people have kind of, may recognize this as a large bear flag, sort of, so to speak, but it's a rising wedge. It never took out its high that it was made, during the just before the great financial crisis. So, and it's been zigzagging up, in this ABCDE triangle, ascending triangle type structure. It's still got to make that E, but these break down the opposite way. A measured move brings it down to just several bucks, if not zero. So I'll kind of dig into that, as far as some of the major banks and financial institutions. But
well, some of the major banks over here in Europe, I think, are going to be having a lot of troubles. Well, in fact, that just watching the news this afternoon and this evening here in the UK, we're seeing large sections of industry closing now, large sections of the service sector. We have had a rise in energy prices of about 1,000% now, and that has been passed on to consumers to the tune of about 400%, 500%, and for those in industry and those who own businesses, they're seeing their energy bills increase 500 to 600% now. So the ramifications from that are going to shake the markets one way or another, and whether it's a government bailout for the entire country, which is going to be larger than the COVID bailout, or whether they fail to step up and hand over the money that's required, in which case everything collapses in the next couple of months. But it's going to be fascinating just to see how these charts react, how markets react to what is a rapidly deteriorating situation here in Europe.
Exactly. It's very frightening, and the news doesn't cover it enough. But yeah, that kind of brings me into that, like, we've seen the deflation, right? The depressionary type, charts here, tech stocks selling off, banks, getting hit. But look at oil here. I mean, it's made, 5 waves up into an intermediate posture, and now it made 5 waves on its intermediate third degree, another 4 pullback, and it's finished 5 waves. That when an asset finishes 5 waves on a larger degree, it kind of sets the trend. Okay, so this pullback we've seen is really just a consolidation wave.
Yeah.
It can go down a little bit further. This B might be actually subcomposed of its own ABC, right? And we can see oil drop down to like $70 a barrel potentially, but it did find support here at the 382. And it's starting to kind of move up a little bit. But again, I'm watching divergences happen, and but 3 comes next, right? And I mentioned before, the 1.0 extension off the 1.2, and this oil's kind of tricky because it went negative. So I'm putting my fib extension line right here where it came up and bounced. So that's a little tricky too. I mean, you can use other charts, that are tied to oil to kind of figure out, where this be, but we could be in the high hundreds, like 160 to $200 a barrel on this wave 3 when it gets up there. And that's highly inflationary, right? I mean, oil is the lifeblood of the economy, and so many products and uses are for it. Gasoline prices tied to it. I mean, that's inflation. So it's like, that brings me back to the thesis where stagflationary depression, things, that people need, and use are going up in price, while things that are, based on debt and credit, are collapsing.
Yeah. Well, I mean, if we're seeing stuff like oil doubling in price, then it's quite feasible to see the S&P and NASDAQ go up nominally by whatever it is, 25, 30% or something, up to 5,000 or 6,000. but that wouldn't that wouldn't be keeping up with the inflationary forces around us, if that was to happen over the next couple of years. So that whole stagflationary backdrop kind of makes the move up in, if it were to happen, the move up in general equities seem pretty insignificant, really.
Exactly.
Mm.
Exactly. But yeah, I think that's pretty much most of what I had for today to show you. I'm still working on parts 2 through, I think it's going to be 2 through 11 for the series I've started. So I welcome viewers to, definitely subscribe to that if they'd like. They can find it on my Twitter page. You went ahead and pinned it. It's over here, Hypersonic 78.
Yeah, I was going to say, tell everybody where they can find you, Hypersonic. Yeah.
Yep. So yeah, I'm on Twitter. Go ahead and just look for the ape with the burning Bank of America behind it. Yeah, the banks, they don't look good. That's kind of why I put that. And ape, yeah, I like silverback, Wall Street silver, let's go. Because I do like silver. I like the silver chart. It's building a base here. The long term, I might as well look at that right now. But yeah, it's doing this kind of crazy thing right now. I think we could get a nominal lower low at this point. Going out to, let's just go ahead and do the all. Oh, too big. It's in this giant cup and handle, but, zooming in, let's do weekly. That might be a little bit cleaner. Yeah, so we had 5 waves up here. If you zoom in, 1, 2, 3, 4, 5, and now it's doing its A, B, C. So, and it's in a.
So is that, would you describe that as a corrective?
Yep, it's corrective.
Yeah.
Yeah. So I mean, if you zoom out even further, from 2011, that was wave 1. It had a 5-wave move up. All right. We didn't know that it was done yet. A lot of people got scared back here in 2008, right? But that was only wave 3. A, B, C.
It's interesting because some Elliott Wave technicians that I follow, I won't name them, but see metals turning up shortly, but describing it as a bear market rally. That is
an alternate. We could say that this whole move to C is really just your A. So we have to be kind of careful of that. The one thing that gives me confidence that it's not a corrective rally is this movement to 1 was 5 waves up. That's impulsive with no overlap. Now 5 was, I wish 5 was a little bit higher. I mean, it just barely made a nominal high. I think that was on silver squeeze day, but it did make a higher high, and there is 5 waves here. If you dissect out, intermediate 1 on that degree.
So if you were to weigh the probabilities of silver making a higher high on its next leg up versus hitting those sort of levels, being rejected and coming down to make new lows, how would you sort of weigh those probabilities?
I think it's high probability that silver breaks out and makes new highs. I mean, at least we'll have to watch the structure. If it's a 5-wave structure up to wave 3, that's bullish. That's, if it's an impulsive rally that I want to see up to 3, I'm in it and I'm buying.
And then a pullback to 4 there, followed by what? Followed by another leg up.
The 5th and final wave.
Yeah. Okay.
Triple digits. Bingo.
Might be. I don't know. I think in 67 to 100 potentially. We'll see. Maybe Keith.
You know what I like about this is I was always curious, like how you project, and since you're using Fibonacci extensions, it kind of makes it methodical, and anybody could start projecting using those fib extensions based off the 1-2 retracement, right?
Exactly.
Right.
Yep. Fibonacci's exist all in nature, right? I mean, in seashells and all over the place, and that we talked about it earlier about the social mood and herding behavior in speculators. It shows up there too, so it gives you a price, to get out.
Fantastic.
And Hypersonic, I can't speak for Kevin, but I really enjoyed this. I let Kevin do the questions because I just wanted to absorb what you were talking about. And we'll put all the links that you mentioned. We're going to put them in the description. And hopefully when you get your part 2 done, just beat me up, and we'll do an expose again, once again, because you're very articulate. And I understood you, so that means a lot of people must have understood you also, right?
I hope so. Yeah, thank you both for having me on. I really enjoyed the time, and yeah, hopefully if this helps someone out there, then yeah, dig into Elliott Wave. It's a lot of fun. The best advice I can give people is just start charting, start doing it yourself. And then see how it plays out, on certain assets, maybe something that you're not invested in, because that builds confidence. You could sign up for, a service and compare yours to the pros like I did. I mean, that's fine, but I learned by doing. So just don't be afraid and practice and make mistakes, and then learn from them.
Yeah, that's how everybody learns, isn't it? Just practice, and practice makes perfect. So yeah, it's I'd go along with that as well, definitely. Fantastic.
Right,
thanks for joining us, Hypersonic. We really appreciated that, and we'll hope to speak to you again very soon.
Yeah, thank you both. Appreciate it.
Thanks, man. Take care, man.
Cheers now. Bye-bye.
Yep.